everyone. Let me ask you something. Leaving aside the world wars, what do you think has been the average duration of wars between countries over last 2 centuries? The typical war is short. Since 1815, average duration of wars between countries has just been over 3 months, calculates Paul Post of the University of Chicago. Interesting, right? In 2003, America toppled the government of Iraq in just 20 days. Conflict that Armenia and Azerbaijan fought in 2020 was over in 44 days. Vietnam War ended in 6 months. Yet, Russia's invasion of Ukraine has entered its 6th month and shows no sign of ending. War doesn't look imminent in Taiwan, but an uneasy peace that had prevailed over the last few decades looked fragile, and Taiwan's importance as a source of semiconductors has upped the ante for the rest of the world. As geopolitics takes the center stage, economic and market outcomes could be very different from the playbook that was operational in last 3 decades. Europe is in the throes of energy shock, bringing the European economy on a serious brink of recession. Commodities, which softened a tad between May to July, rose once again in August. Natural gas prices rose 22% month on month. Eventually, weaker global growth will drive commodities down, but there could be interim bouts of volatility. What was supposed to be a gentle rise in interest rates over an elongated time frame is now a rapid one in a compressed time frame, and yet inflation is far from being vanquished. US Fed Chair reiterated his inflation concern in the latest Jackson Hole Symposium, hinting at the higher interest rates for longer. US economy is presently strong, but Fed's aggressive and rapid rate action will eventually engineer a recession in the economy, predicted to materialize around later half of 2023. US yield curve is now decisively inverted, and historically this has been a harbinger of recession. In China, households have boycotted mortgage payments, symptomatic of bigger problems in the economy. Unemployment rates for Chinese graduates have surged over 19%. The economy is struggling with havoc of zero COVID strategy. 2022 growth expectations for China has been lowered to around 3 to 4%, unheard of since 1990s. Hence, think about it. 3 big global economic blocs is either struggling with growth or face the prospects of serious slowdown. In India, Q1 FY23 GDP growth at 13.5% underwhelmed market and RBI expectations of around 15 to 16% of growth. High inflation impacts the volume growth in household spending. Looking ahead, consumption demand in India will be slow to recover. A decade long of low investment and improved balance sheets has brightened the prospects of capex uptick across corporate, infrastructure and residential real estate. Indian manufacturers are presently benefiting from Europe's energy stress and China Plus One strategy. But as the global pie shrinks, India's export may also slow down. Thus, it is primarily the global sluggishness which calls for a downside risks to India's growth. This also warrants some near-term downgrade risks to earnings. even as earnings may be headed for higher in the medium term. In this context, we believe it may be premature to declare an end to the current volatility. Indian Nifty has rallied 12.5% between July and August, significantly outperforming peers. FIIs have returned to India and invested over $7 billion in last 2 months. But investors would do well to not get carried away with the last 2 months of rally, given the global growth risks. Investors should stay patient and stick to their long-term asset allocation. It is patience through the turbulence that is likely to be rewarded on the other side, given that corporate earnings have likely turned the corner and are likely to trend higher over the medium term. In the fixed income space, repo rate was hiked by 50 basis points to 5.4% in August policy. Significant takeaway has been the RBI governor's statement to align inflation outcomes closer to the policy target, that is 4%, assuming average CPI around 5% in FY24, policy rates should be 6% as a base case if one were to look at real positive rates. Recent RBI research papers have estimated a range of real rates around 0.8 to 1% in Indian context. As we have maintained earlier, policy rates moving closer to the neutral, RBI emphasizing the midpoint target of 4% while being alert towards external sector stability were the key variables to provide more confidence. This has largely been met with the MPC meeting in August and hence provides us some space to incrementally add duration. However, volatility in rates market, especially in the context of continuous repricing of policy rate expectations in the overseas market, would warrant a staggered approach alongside adequate focus on liquidity. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.